Hey guys, welcome back to my channel. My name is Ashton and this is financial advice. Today's video is about what you should be doing right now in the stock market. For the past week, the stock market's been going up and it's been going down, and it's like, man, what do I do? What do I do in this market? It's crazy right now. Today, I've got 4 options for you to consider. Option number 1, take care of your debt. That's very easy, very basic if you have debt. The debt that I'm talking about is consumer debt, your credit card debt. Why your credit card debt? Because credit card debt, the interest rate is high. You know, your card can be anywhere from 14% to 21%. If you don't understand what I'm talking about, I mean, I'm sure you know when you use a credit card, you pay an extra fee based off the money that you've used, so essentially borrowed. You're kind of borrowing money. You're paying for the use of money. That's what interest is. And so it's better to take care of your debt than to use your money to invest. And the reason why is because it's hard to compete between an interest rate and your own return on investment in the stock market. Option number 2, it's okay to sit on the sidelines for the remainder of this quarter of the year. Maybe wait until July, August, September, and then maybe start jumping in. Just see what's going on. As an investor, you don't have to be forced to enter the market. You can sit with your cash and wait for a better opportunity, or to kind of find what market you want to get into. And there's a lot of activity going on in the market right now. You could play it safe with strong companies, or you could use part of your money to put more aggressively somewhere else. But that's up for you to decide with what you want to do. Sitting on the sidelines almost feels like you're helpless, but really what you're doing is you're monitoring the game with what's going on. It's a good option for some people. Consider it. Now, it's a short term, you're looking at a short term activity, but the stock market is always good long term. The third option that I recommend is to invest in strong companies. So to find a strong company, you need to be able to look at their financial statements, which is easy to do. Whichever company that you're interested in, you can go to the SEC. You can typically go to the company's website, and they've got a financial section towards the bottom. You could use Google, type in the company financial statements. It's going to pop up. Yahoo Financials shows financial statements, and the statements you want to really be looking at are the income statement, the balance sheet, and if you understand how cash flow works, you can look at the cash flow statement as well. The company issues their financials to the SEC, and you'll get more information from the SEC. That typically will take you, if you know how to analyze well, it could take an hour per company if you really want to read through all the documentations that they provide. So what is a strong company? A strong company will have a earnings per share that's positive, and the higher the better. Experts recommend that you kind of want to have a company that's low but not in the negatives. You want a company with an EPS that's low, because that means that there's room for growth. So if you find a company that's hovering around 1 and 2, that might be a good option. You want to take a look at their assets over liabilities. So you take the total assets from the balance sheet, subtract it from total liabilities, and if it's positive, the company is doing well. Take a look at their net income for the last few years. So look at the income statement towards the bottom. You can see their net income. See it for the current year, see what happened last year, see what happened the year before. What you're looking for is positivity. Has the company had a loss in the last few years, and you do not want to invest in a company that's had multiple losses year over year over year. Take a look at their competitor and see how their financial statement compares. If you want to get a good sense of what a really good financial statement looks like, look at Apple, look at Amazon. Option 4. A lot of you won't like this option, but stay out of the market for the year. Maybe you have a need in your household, in your situation. It could be a vehicle, it could be just clothes, food, anything that you need. Maybe your money would be better spent within your household than having it put up in the market. Because you don't want to risk that short game. In the long game, your options are pretty good. Like even with Amazon, Apple, all the big companies on the Dow, whatever, even though a lot of them are expensive, if you are investing money into these companies and over the course of 5 years, you'll find that you've probably made $70, $100, $200 a share. Anything's possible. Amazon, you could be making $500 to $1,000 in 5 years. Who knows? It's very unlikely that these companies are going to collapse. Nothing's impossible. You take your own risk. But these are the options that I have for you guys. Take them as you will. Don't forget to like, subscribe. If you have any questions, comment below and I'll get back to you. Thank you for watching this video. I appreciate it. Till next time.